Okay, then I would like to invite the panel. Who has traveled most? Okay, in this case, it's a pretty easy answer. So I first would like to welcome Louis Kent, who came from Australia all the way down here to, or up here to Toronto. Louis, could you please come to the stage? You're very welcome. He's senior manager at Energetics. Energetics is an Australian-based energy and carbon consultancy. Your background is you are an energy scientist and an economist. And afterwards, I will give a couple of minutes to, or a minute to everyone to do a proper introduction. I just do the very basics here at the moment. Then let's mix it a little bit up. A mining company, we have another Louis on board, Louis Turner. He works for Primero Mining. He is Vice President Project Development and Construction. Thank you very much, Louis, for replacing Ernie Mast, who could not come today. Thank you very much for being here with us and joining the discussions. Then we have Frank Kelly. He's Director Structured and Project Finance at the Canadian Development Bank. He will give us very interesting insights to this very new topic and how a development bank actually is dealing with it. By the way, he has a background in energy and in mining, so for this discussion, I think he is perfectly suited to contribute to this discussion. Sorry for that. Finally, a banker, a commercial banker, to be more precise. Chris Moscardelli is Director Energy and Project Financing of Societe Generale. He's based in New York, came over from New York to escape Trump, probably. I'm not sure whether he will stay here or not. He's focusing on the energy sector, not only renewable energy, but also renewable energy. He has a long track record in arranging and advising transmission projects, renewable energy projects, gas projects, oil projects, and power projects in general. So, thank you very much for being here. Maybe we just start with the introduction in your own words. Why are you here? What can you contribute? This is what I would be very interested in.
Okay, why am I here? It was almost a bit of an accident. I got a call from Adrian because she'd been speaking to Andrew Drager, who is the brother of Peter Drager, who we heard from earlier on today, because I'm involved in a number of groups in Perth that organise events. So it was about this event potentially, I think it is coming to Perth next year, which would be great, a bit less travel for me. Had a bit of a conversation with Adrian and gave a bit of the perspective of what we've been seeing as the things that are holding mining companies back, because we've been around. Energetics was founded in the year that I was born, so it's been around for a while. It's been doing energy for a long time before it was a popular thing to do. And for many years we've been looking at projects where renewables stacked up perfectly fine. The financials were there, technicals were there, but they haven't been happening. And for us, the tipping point was around December last year. Suddenly everything kicked into gear, and I think it was a number of things. It was the Paris Agreement going through, the continuing drop in the cost of renewable energy, but also Australia specific. There were a number of high-profile renewable energy projects for mining companies. I think the highest profile one was the Dewey Sandfire project, and it was just a matter of they were in the newspapers, so mining companies read about it and started asking questions and needed answers, and we were there to help guide that process of refining the business case and working out what the best solution was for mining companies. There's still a lot of hurdles in the market, trying to get the decision-making processes that the people in the renewables and financing side understand in detail to fit with the decision-making processes of mining companies, and there's often a few stones in the gears when that decision-making is going on.
Yeah, and thank you very much. And Louis, it would be great if you could also explain a little bit what kind of mines are you having? Are they grid connected? In which countries are they? And just as an introduction for our upcoming discussions.
Okay, yep. Hi. Oh, sorry. To even pronounce the same.
Everybody can hear me? Yeah. Okay. First of all, we have Primero Mining. We own 2 mines, one in Ontario, which is connected to the grid. So I won't talk too much about that one. I'll focus more on our Mexican operation. We have a mine in San Dimas. It's in the state of Durango, but on about halfway between the city of Durango and Mazatlan, which is in Sinaloa state. That mine is produces gold and silver and consumes around from 11 to 14 megawatts of power. And it's split between, we are connected to the grid, but we have a weak connection, so the grid can deliver 5 or 6 megawatts. We have hydroelectricity. We have a hydro facility. It's about 40 kilometers from the mine site. And then we also have as a backup some diesel generation capacity. The diesel generating capacity is actually quite weak. They're old generators, so it's not too reliable. So basically we have an energy challenge. We've done some upgrades in the hydroelectricity over the years, and today where we stand is that we can generate during the rainy season. We can generate the 14 megawatts that we need to operate the mine. But during the dry season, because we don't have enough water storage capacity, I know there's been a lot of discussion about storage, but our type of storage issues are slightly different. So during the dry season, we have to manage our water through the 8 months that it doesn't rain very often. And so we produce maybe 6 megawatts. So we are really, if you add it up, 6 plus 6, a bit of diesel. So basically we can manage with the installations we have, but it's at a high cost. The cost of diesel, as you know, is 30-35 cents a kilowatt hour. Whereas when we produce hydro, we're down to $1.50. Just because the installation is there, we just work it out through our OPEX. And then electricity off the grid is about 10 cents. So if you look at that whole mix, we need to have a reliable source. And so the answer for us really is to improve our hydroelectricity. So why am I here is really to talk about that part of the project, and it involves financing and other aspects. So
excellent.
Yeah,
thank you very much, Louis. Frank, looking forward to.
So as Tomas said, my name is Frank Kelly. I'm the Director of Extractive Industries for the Structured and Project Finance team at Export Development Canada. I've been doing project finance for 22 years, and so part of my responsibilities right now include oversight for the mining sector, oil and gas, and resources. But formerly I was responsible for the energy sector, which covered power as well. I probably will let you all decide as to why I'm here at the end of this presentation, and hopefully it's some value add with regards to how Export Development Canada approaches financing for projects at the level of perhaps the mining sector, which we have a fair amount of experience in over the last number of years. But what we're drilling down on a little bit today is how that financing may be applicable in the context of microgrids, which may be introduced, as we've heard over the last couple of days, through some type of hybrid structures or introduction of renewable energy into existing mining facilities, whether it be through some type of PPA arrangement or otherwise. And through our conversation today, we'll expand upon that. Thank you.
Thank you very much, Frank. So, Chris, you are a banker. Normally you look at large-scale projects. Right now you are somehow in this panel for microgrids.
Right.
It's very
So,
interesting.
thank you, Thomas. Well, my name is Chris Moscardelli. I am based in New York. I did not come here to flee our president-elect, contrary to popular belief. And it's very nice here. I might stay, although it is freezing up here. I got to say that. And I live in New York. I don't even live in the South. But I work for Société Générale. I'm very excited to be here. We are a global bank. We're based in Paris, one of the biggest banks in France. I sit in New York where I cover energy finance for all the Americas, so Canada, US, Mexico, all the way through all of Latin America. And we have a broad definition of energy. We finance baseload power plants, all renewable energy, pipelines, LNG, kind of you name it. If you can find it, put it somehow under a definition of energy, we'll take a look at it and finance projects. We did recently finance a solar project in Chile that had a mining company offtake, and so that's what really kind of initiated my interest in exploring this sector more and the synergies between mines and solar and renewable energy companies, not just solar. So I'm excited to be here, and has been a great discussion for the last couple of days. And I appreciate you not booing when I get up onto the stage, as I am a banker. I usually meet the stage with a round of boos. So I apologize for your exercising restraint in that regard.
Thank you very much. So I would like to start with a question regarding return expectations from investors into mines. So Luis, I think that I put the two Luis here directly in the front. I did not really think about it right now. It will be a bit complicated. So I say, I talk directly about mining and Primero. What kind of expectations, return expectations, do your investors actually have?
Well, it depends on the price of gold, I think. It's generally speaking, it's hard to put a number, but generally if we can get 20% return, I mean, I think if people are generally happy. There's a lot of risk, as you all know. The price of, it's hard to predict the commodity price. And so even for 20%, you need to de-risk the project a lot and eliminate a lot of the variables from the equation so that you at least get something that you can defend. Everybody would like to see more. But as a general rule, while we're evaluating a project, we'll use that as sort of a hurdle and then take it to the next level. So.
Yeah, 20%. We had that in Europe once when projects were over-subsidized. Right now for grid-connected projects, at least for renewable energy investors, these 20% would be really outstanding. And probably if you did mining in African countries, it would be even much higher, I suppose.
Right. That's right.
A question I always ask myself, if you build a renewable energy plant next to a mine and the destiny of that particular plant, at least to some extent, is really linked to a mine, shouldn't be the return, the IRR expectations be similar for the renewable energy asset in comparison to the other pure core mining assets? Maybe what is the perspective from the banking side about this part, or under what conditions could there be differences regarding the return expectation? At least in off-grid, I think your mines are not, or it's not a complete off-grid mine, so you could feedback, but just thinking about if it's really an off-grid, a remote mine, if you don't have another off-taker for the power that is locally generated.
You want to take first crack at that, or do you want me to go? All right. So one of the things I think that's important to look at is, and I had mentioned this during our pre-discussion earlier today, is project-on-project risk. And so to answer Tomas's question, I think it's important to, if you're looking at financing in a contained package that would be directly related to the renewable energy piece, then arguably the flow-through to the underlying mine asset is key. So I guess by that definition, you would argue that the return for both, I'm not speaking as an investor, but it is important from a banker's perspective that the return for the stakeholders in the project is adequate and certainly incentivizes all interests. So arguably the return should probably be pretty close to equal, I think, on both. The important part of the project-on-project risk, and again, I'm perhaps bringing a more narrow perspective, given that, as I said, my background is mostly project finance, but it could be also suggested that if the renewable energy piece was really taking corporate risk of the developer behind the mine itself, then perhaps with lower risk, it would warrant a lower return. But I'm more looking at it in the context of a project finance structure based on a project finance underlying asset, and therefore the fundamentals of the underlying asset is really going to be the key element from at least from a lender's perspective, as we would look at the asset to ensure that there is an equitable return. The last thing we want to see happen is that the investors are not making what they believe to be their hurdle rates. Otherwise, that creates a further problem for the lenders themselves.
Yeah, that's well said, Frank, and I agree. It's all about risk return, right? And from a lending perspective or from the equity perspective, where the question was posed from a return perspective, broadly defined, it's all about having a commensurate return, a return that's commensurate with your risk. And so where Frank and I sit on the debt side, we're lending to projects, and our capital is extremely inexpensive. We're lending for many, many years at 4 to 5%. That's debt returns. We have no upside in these projects. We just want to get our money back over a certain period of time. And for that return, we mitigate a lot of the risk, or we push risks off to those that are best able to handle those risks. And so from an equity perspective, sure, the earlier you get in, the project-on-project risk, all the things that could go wrong, you assess, but you're getting compensated a lot more than you would on the debt side. So the question is actually, you'd have probably a slightly different answer between debt and equity, I'd say, because obviously we're taking on more or less risk depending on who you're speaking to. But I agree, the return should be commensurate with the risk taken by that particular investor and the type of investor that you are.
Luis, from the consultant perspective, this morning and as well yesterday, we've heard quite a lot about making renewable energy solutions transportable, redeployable. What do you think? Is this a good mean to de-link the destiny of the renewable energy asset from actually the mining assets?
Potentially. So I'll just, before I jump into that, one thing on another potential delinkage between the risk profile of the mine and the risk of the asset is something that Sakani referred to this morning, which is if it's a mine that has an ongoing energy requirement, then that de-risks the energy investment because it's still providing value and still generating returns. So that's one way that it can be different. As far as the redeployable renewables go, we're always interested in that because we do have times where mine life is a concern for projects that we're evaluating, but to be blatantly honest, we're a bit lazy and we go for, there's enough opportunities out there where mine life isn't a concern that we generally focus on those ones because they're the easier ones to get over the line in the first place. So in those instances, if one example is got a scenario where we've got a 10-year mine life or 12-year mine life, the investment will have paid itself off by then and it's got a good net present value over that period, even though the mine life may be extended after that and the asset itself definitely has more useful value. The PV modules will last a lot longer. For our financial analysis, the mining companies like it to be conservative, so we just assume zero value after that 12 years. Everything after that is upside. We're just looking to get it to the point where you can make that investment decision. So, so in scenarios where, as long as we can make the investment decision, justify the project to go ahead, then we don't try and stack more value on top of that. And with the ones where the mine life is marginal, generally, we're working with large mining companies that have a large portfolio. So the ones that are marginal, they put on the shelf to think about later on, and we just focus on the ones that do have the solid mine life to begin with. So it would open up a whole nother level of opportunities with the companies that we're working with, but at the moment it's not something that's critical for all of the opportunities.
Yeah, and if a mine cannot really pay for economic reasons, pay the electricity, so for this downside potential basically, that you plan a renewable energy asset for 10, 15 years, and after 5 years, let's say copper prices are very low and the mine operations are shut. The PPA was closed with the mine itself and not on a group level. Do you think it is necessary at this stage to think towards redeployable PV, or does it just add cost on it? And if you, for example, have a portfolio of different projects, you de-risk your portfolio basically through this diversification?
Yeah, it definitely reduces risk, and it's one of those things. If you've got the option there and it doesn't significantly add to the initial cost and doesn't have other negative effects on the operation of the plant, then it's one of those things. If you've got the opportunity there, you definitely take it. But generally, we're looking at projects where they're cheaper, lower quartile, cost quartile producers, so they're very safe in their mine life. They're going to be operating for a long time. They're the ones that we're focusing on at the moment. So with them, it's more about just trying to make the project as suited to their situation as possible. And because their situation is long, low-risk mine life, then it's not something that's high on their register. But they're always interested for those other mine sites where they do have a shorter life. It's something that is always coming up as questions from the mining companies that we're working with. They're asking about the redeployable stuff because it's the type of thing that does pop up in news articles, so people see it, they hear about it. We haven't found, with the projects that we're looking at, that there are redeployable options that are as competitive, and because there's not a lot of mine life risk with the projects that we're looking at, there's no reason to justify the additional capex up front to go for the redeployable options.
Okay. Louis, Mexico, to make clear who it is. You think about doubling basically the capacity of your hydropower plant. What are the options? How is the process? You see that you don't have enough electricity basically. So how do you start from that observation?
Well, in our instance, the idea of the project really is to increase the water storage capacity. So to build another dam upstream of the one that we have today, and basically we would be able to store enough water to be able to produce basically 100% of our electricity needs on a year-round basis. So it's a very attractive project, and the question for us really is the deployment of capital. Do we use our own capital? We're a mining company. We're not really an energy producer, although we produce energy. It's not our specialty. So the question is, okay, do we use our own capital rather than spending in the mine, or go out and get financing? So we've looked at project financing. We've also looked at monetizing the asset and developing a deal, a PPA arrangement with a third party. And that will raise the questions, as you say, about redeployment, which is something that we've looked at as well. We are connected to the grid, but it's a weak connection. So what's the, if the mine shuts down, what's the option for the investor? So again, when we talk about redeployment, for us it probably means adding another. We know there's another mine 10 kilometers away. Maybe it's just a question of running another power line. So for us, it's really a lot of different elements, and at the end of the day, it's really where do we get the capital? How do we convince the investor that there's enough mine life there for them to recover their investment? We do know the mine's been operating for 100 years, and 60%, we've only explored 60% of the property, so we know ourselves that there's mine life, but then we have to convince the bankers that it's there, and so that's where we sell our side, or geology, and what's the exploration potential and all that. So there's a lot of elements to it.
Which banks are you first talking to? Is it the banks you already work with, whom you have already convinced once that there is a certain lifetime of the mine, or do you?
Well, actually, that's a good question. There are those bankers, the ones that actually have security over the property already. I won't mention them, but there's also in Mexico, there is a FIFOMI, which is a national bank which funds mining projects. But they fund mining projects that are not really specialized in hydro, so they lack the expertise to evaluate the project. So then that means some sort of alliance with somebody else who knows hydro. There's also there's another element to it that makes it attractive for certain other types of groups. If you take the CAF, the Banco Andino, which looks at the social side of it. Our project is located on ejido lands, and as part of the arrangements we have with the local ejidos is to we supply power to their communities. So we have these arrangements. We have 40 kilometers of transmission line. There are communities along the way, so we actually provide power to all of these communities. So that type of financing institution finds that attractive, and that's something that will interest them in terms of investing in our facility. So those are possibilities that are open. We've talked to those people.
So just if you sold your existing hydropower plant to an IPP and they would build or add the new capacity for you, basically it's important as well, if I understand, that this is respected then, the existing community efforts which you are having.
Yes, and actually that's probably one of the most important criteria. Not only would we want to team up with a partner who understands our needs and can operate the facility in a way that meets our requirements, but it's also sorry, but also that they don't damage the relationships that we've spent years building with the local communities. One false step there can mean shutting down the facility. So it's something that has to be managed. It has to be well, and so anybody investing really has to work with us on that element.
Yeah, in these periods of low interest, more and more companies with a financial background are actually looking to equity investment and basically to assuming an IPP role. What is your feeling? What are your requirements towards potential IPPs that could run your power plant and sell electricity to you? Some of these companies might be even completely new in this energy provider role, electricity provider role.
Well, that's, I think it's a question you have to ask them at the same time. I think there are quite a few players out there. We've seen some of them in the last 2 days, and there are some out there, other ones. It really, in one part of it, we have to meet their criteria. We're the ones that are asking for the money. So we have to satisfy their requirements. There's a question of size of the project. There's a question of location. I mean, there's a lot of, and I think I'd rather pass the question on to maybe our gentleman.
Okay. Size of the project was okay.
I was just going to add, based on what Louis was mentioning, I mean, when the term renewable energy is referenced, and in this particular case, we're talking about a hydro facility, and what I was hearing from Louis embedded in that is that one of the key elements, obviously, is the automatic consideration of renewable, also carries with it the entire environmental, corporate social responsibility elements that accompany that. So I would just want to sort of reemphasize a little bit that the gestation periods on those types of conversions are not as swift as they may be. So as a planning process, those things do need longer lead times to give consideration to build out the environmental and social impact assessment, have that properly vetted. I mean, these are all common sense things, but as I said, it's an important consideration when taking into account not only the investor's interest, but also lender's interest from the perspective of reputation risk, as well as the obligations that certain lenders have, whether it be with respect to the Equator Principles or any other overriding element that would fall under the OECD consensus and common approaches, et cetera. So I just wanted to expand upon that a little bit in the sense of the importance of the lead time that would be accompanying such a decision.
that process, the environmental social process, reputational risk process, has really mushroomed for banks in their credit analysis. So completely agree with Frank. It sounds like you're going through the same thing we do. Whereas in the past, it was a bit more of an afterthought. Hey, it would be nice that if this was a green project, and but that didn't drive the boat. Nowadays, we spend just as much time with our credit committee getting approval for a loan to a company as we do with our environmental and social committees and our reputational risk committees, because in the context of equitable principles, it's very, very, very important to banks, and we take this very, very seriously. It's not going to drive our economics. It's not going to drive the return on our loan. It's not going to drive client relationships, but it is very, very important to us that we are environmentally and socially conscious, and we do not lend money to kind of bad people in bad places.
Just adding on that, it ties into the question before about redeployable benefits. One of the projects we're working on at the moment, it depends on your definition of redeployable. It's not about picking the asset up and moving it elsewhere, but at the end of mine life, the plan is to redeploy the facility as far as the energy consumption to the local community. And that, fortunately, there's a local community nearby there that will remain after the mine closes. And that has actually been a very important factor in the decision-making process. And it also impacts the design of the optimal system at the start, because if you're planning to pass it over to the local community at the end of the mine life, then that means that you might tweak the size of the PV array, might plan for additional battery storage to be added in a decade's time, and that benefit is not necessarily something it could add value to the renewables that are being deployed, but the real value to the mining company is that positive legacy of leaving a benefit for the community after they leave that's a real significant benefit to the community, and that adds to their credentials when they go and try and develop the next mine. They can go to the next community and say, this is one that we did recently, this is what we left them with, and we have a similar plan to do that here, and it's not just greenwashing to try and hoodwink you, it's something that we've done before and we're planning to do again.
Thank you. Before we heard the aspect of size, I think you were mentioned it, Louis, regarding your Mexico operation, that banks have certain requirements, or in general, investors have certain requirements regarding size. As an export development bank, how happy are you with solar and wind? So especially in this context of off-grid, we talk about rather small installations. What value can you actually add for these relatively small investments, or not investments?
Yeah, that's a very good question. I mean, one of the things that we at EDC, what we try not to do is be discriminatory in the sense of size of a particular project, and that's not as easy as it sounds. Again, depending on the nature of the counterparty risk. I mean, if it's corporate, then it's a smoother and easier process, and I say that from the perspective that project finance can be long, it can be expensive, it may not always be the best solution for certain types of projects, but with that also come economies of scale in the, as I said, in sort of the PF space versus the corporate space. So while we would not say that a project is too small, I think we would look at it in the sense of, does it make complete economic sense for the stakeholders that are involved in the project, whether it be the counterparty of the host mining entity, whether it be the developer that is looking at the renewable energy project as a source of energy for the mining company as an off-taker. And in that, practically speaking, there's also some value from where we sit, where we're able to partner with other finance entities, whether it be commercial banks and SocGen and EDC have a long relationship where we've worked together on a number of transactions. So whether in the commercial bank space or whether it be with multilaterals, IFC, or with other types of development banks, and the DNR development is development of Canada. So we're basically supporting Canadian export and Canadian investment. But whether or not it's, as I said, multilaterals, or whether it's also includes local financial institutions. So there are some values that can be added to that without actually being too prescriptive about the size of the underlying financing that may be necessary.
Yeah, Chris,
Yeah,
I think Societe Generale normally finance.
At SocGen, we do have a minimum size deal. So, as much as I hate to say that, we're a large lender to project finance deals globally. We deploy billions and billions of dollars of capital, sometimes on an individual project. And so I get a call at least once a week from a project developer with a fascinating project, a very interesting project. From a credit perspective, we would get it approved and deploy our capital to that project. But for many reasons, it's just too small. For many times, it's just too small. Frankly, we have a sort of a minimum deal size of about $75 million. So anything kind of south of that, it's difficult for us to take a look at, because really it's a resource allocation and time management perspective. I have a team, and it takes the same amount of work to finance a $50 million deal as it does a $500 million deal. And so it's really becomes a risk-return issue for us. And so it's not to say there's not a market for smaller deals, smaller than $75 million. There are tons and tons of lenders that would look at smaller deals. SocGen just happens to focus on larger deals. Aligning with an EDC, and they, to Frank's point, they work with a lot of different types of banks, including SocGen, but a lot of banks that have a different focus area than us when it comes to size. So there's a market out there for small deals, but we unfortunately do tend to look at the bigger deals. And the renewable energy projects that we finance associated with mines are really utility scale. They are the larger projects.
Thank you. Louis, in Australia, we've seen already interesting projects. We've heard this morning about Sandfire. So the technology is mature. It is working, medium-high penetration, off-grid. Plenty of companies are investing. Chris was mentioning that there are lenders who are also going into small-scale or smaller-scale projects. Why is the market not really taking off? What is your impression? You are really probably still at the most active, you oversee the most active niche of the market in Australia, but why isn't more happening at the moment?
Yeah, that's something that we'd been scratching our heads about for a while, and I think it comes down to the decision-making process of the mining companies that we work with, at least, where there's continually a range of things that come forward that mean that that the projects aren't evaluated in the way that you'd expect them to be. And one example of that is one of the companies we've worked with simply said our internal process is that before we would look at this as a PPA or an OPEX style cost, our protocol is to assess it as a CapEx cost, and if we wouldn't do it as a CapEx project, we won't look at it as an OPEX project, which doesn't really make sense. And in addition to that, the way that they assessed it as a CapEx project was exactly the same as the other mining projects that they did. So it didn't acknowledge the difference in risk profiles between a renewable resource going in versus developing a new pit where you've done some drilling and have an idea of the resource. So in that process, we're still going through the process of evaluating it as a CapEx project, but depending on who's in the meeting on the day, you hear comments like our threshold is that if it's a $20 million project, it needs to have a $20 million NPV, because that's a rule of thumb we use, which doesn't really apply to renewables projects, especially when they're low-risk renewables projects. You should be assessing them in a different way. Additionally, if you're coming to a mining company as a supplier, then the numbers that you put forward, the mining company will take it to their finance team to evaluate it, and they'll rework all of their numbers and they'll change your assumptions and they'll try and make it fit into their models. And often there are things that they're unfamiliar with So they take a conservative approach. And all of these little tweaks and assumptions that they make in assessing the numbers you've put forward can take it from a go to a no-go. An example of that is a project where we're looking at a wind resource for a mine, and we had got some site-specific wind modelling. It wasn't measured data, but it was wind modelling data, and mapped that with, or modelled it with the turbines that we were proposing. Came up with a capacity factor and a sensitivity around that. And they came back and said, oh, we don't think this will work because the capacity factor you used is way too high. And we were kind of surprised because they didn't have wind experience. And we said, oh, what do you mean by that? And they said, well, we did a bit of Googling and we found this report from 2 years ago that said the average capacity factor globally for wind farms is 38%, which it may well be, but that doesn't mean it's going to be at that site. But they're the kind of just sort of logical failings that result in significant numbers changing, and projects that a lot of people in this room would see as a clearly good project just not going ahead.
Very interesting. So thank you very much. I just got a signal that our time for this panel is over. Thank you very much for these very valuable insights into financing microgrid projects, or maybe even a little bit more general of financing renewable energy projects in general. Thank you very much.